All right, we're live. What's going on, guys? So today is going to be a little bit of a different video. I'm not necessarily going to be picking my stocks or anything like that right now. I probably will maybe in the end of this video, or maybe later into the next video that I'll do sometime this weekend. This is like I said earlier, and I'll still continue to say that these videos are not really for anyone in particular. These are mostly for my own benefit, so I can kind of understand what my type of thinking is as far as these are concerned. However, today I was thinking about it a bit, and I think I want to discuss the mathematics of the stock market, and really the mathematics of anything, and how that relates into where it comes to making money, and where it comes to being profitable versus taking losses. I mean, so that I think is I think this is in general a very fascinating topic, because math is in everything, and this is going to be a very nerdy video for the record. It's in everything. I mean these tickers, these ticks that are going up, these candles as they produce these volumes, all of this adds up to something. I mean, when you take this volume, when you take the number of people that own, for example, a share of Intel at this point, at this exact price, the market cap of this stock is some number, right? If you look at a stock like Microsoft, this is one of the $3 trillion companies as of now. Microsoft is at its all-time highs, which is, of course, unsurprising. At this point right here, Microsoft would be considered to be one of the three, I believe there's three, there should be three, it should be Apple, Amazon, and Microsoft, that are the $3 trillion companies, and it is worth $1 trillion here, but not $1 trillion here. Why is that? Well, that has to do with the number of shares that are in liquidity. It's called float. So, for example, the float here is it could be lower, it could be the same. Regardless of whatever it is, the float here is trading. Actually, let me actually start doing a little bit of calculations, because let's why not, right? It's fun. Let me move this here, move that there. All right, great. So, boom. Okay, cool. So let's talk about float. So let's talk about like the value of certain stocks under what circumstances, things of that nature. So where is my mouse? There it is. Okay. So for example, so maybe quickly we'll just talk about what a market cap is. So a market cap means what is the exact term? It's like the market cap is basically the total value of a company as far as like the traded amount. And what that kind of means is it's how we actually, I think, recognize what the growth of a company is, for example, right? So if you know what they're worth at some point in 2005, and then their worth changes over time, then you see that they've grown quite a bit. So, for example, you can take this. So let's think about it this way. So market cap, I think I just remembered. Okay, so market cap means market capitalization, which is the price of a share times the number of shares in the float. So, and that makes sense, right? So if I have $100 trading for a stock like Microsoft, and I have 10 of those shares in liquidity, what is the total value of the stock? It's $1,000, right? Or I'm sorry, it's $1,000. So it's $1,000 that's sitting in the actual float. The value of the market cap of this stock would be considered to be $1,000. Now you consider that the price of Amazon or Microsoft is going at 139 times whatever trillion dollars is into that, or whatever billion dollars is in that company. Well, I could actually do that math. You could calculate the fact that maybe it's $1 trillion company by virtue of the fact that, for example, so actually, you know what? This is really kind of fucking awesome. So I'm gonna actually talk about this. So let's delete this. Okay. So firstly, let's break down basic numbers, okay? Because like I said, this is for me. It's not. I don't give a shit if you care. $1 billion. All right. All right. This is a number that's mostly inconceivable, but it's written like this. That's a million. This is a billion, also known as 1,000 million. So that is how you can conceive this. So what is a million? A million. Yeah, whatever. That's all I'm trying to write. So 1 million is 1,000 hundred thousands, right? And that makes actual sense. Like this is what 100,000 would be equal to. And plus these two digits, and then you have this, which is 1,000. So that's how you conceptualize what a market, what a actual, what a million is, or what a billion is. So you can consider it that way, because and that makes actually kind of sense, because when you take let me clear this again. What the hell is that? Okay, when you take this, say you break this up and into these parts. So you say that all right. For example, a million. So $999,000 and $999,000 and 999. Whatever, 900. Okay, this number is hard to say, and I'm kind of stupid. So there you go. So this is not a million. This is close though. Then you add one, and then that takes it to 1 million. But the idea here is that this is 1,000 thousands. That's what gets you to 1,000 thousands would get you to 1 million. So that's the thing when it comes to this stuff. It gets a little bit. The numbers start getting a bit huge and a bit weird, and they're hard to kind of follow. But essentially, just keep in mind. So, and this is really difficult to really conceptualize, but whatever a million is, 1,000 of those are considered 1 billion. And that, I think, just understanding that in general is the first step to really understanding what a market cap is and what $1 billion even is. When people say that Jeff Bezos has, well, I don't know, what is it, like $68 billion, $68 billion, he has $6,800 million, which is a ludicrously high number, because $6,800 million is made up of 1,000, or at least one single $1 million is made up of 1,000 hundred thousands. That's not right. No, it's made up of 10 hundred thousands, made up of 100 10,000s. So I realize that's kind of up in the air in some regard, because it's like what is the point of this? But the point of this is to understand, I think, conceptually, when you're dealing with these types of numbers that are so big, it goes further than just being able to, It goes further than just being able to, trade and buy shares and make some sort of percentage. I think there's a value to it that matters. Like, why would people keep investing in Microsoft if it's worth $1 trillion? So, and then why would people keep investing in Apple, and why would people keep investing in Amazon when these companies have such enormous amounts of funds, are worth so enormously much? I mean, what does that provide? And I think that's where you'd have to really think about it. Okay, so let's go back to the whole Microsoft thing. So they're worth let's just say, for the sake of reason, because it's 139.39. So $140 is the cost of their share. So then we know that the company is worth nearly $1 trillion. So firstly, this number is pretty inconceivable, because no human being on Earth will ever be able to own this within the next 10 years, because it's just too insane. But you have to kind of conceptualize it. So let's break that just conceptually down. So there's some number of shares that would equal to this stock being worth $1 trillion. Now, that already is kind of understood, that it's gonna have to be more than $1 million. It's going to have to be more than hold on, I got something. Okay, so let's think about it this way. Okay, so the company is worth more than $1 billion. They have to have billions of shares. How many billions? I would say, if I'm just doing this off the top of my head, it'd be 10. I think it'd be nearly 10 billion shares floating. So let me actually look that up then, because this is interesting, and it's actually information that I don't know. I'm doing it as we talk about it. So. Okay, cool. So we were close. We're a little bit off. So it says here, I'll just show the document or the paper. So in 2018, we had there were about 7.753 billion shares in Microsoft's float. And then that at a rate of $140 per share. We can do the math. I'll bring up a calculator if that's something you want to try, just to conceptualize this number. So $140 times, all right, this is going to be very fucking weird. 753, 7.75. So that's 750. This is 753 million. This is the billionth. All right, that should be 7.7 million. And voila. And that is our 1 trillionth number. So conceptually speaking, that does make sense, right? This is the approximate value of whatever Microsoft is trading at. That is approximately what their market capitalization is. And so with that in mind, what the hell does this mean? What does this matter? Well, I think that is the point. You have to understand really what this matters. And I even I don't fully understand this number is not something that I would ever receive. I own, maybe if I own 100 shares of this, I own a remarkably small portion of this. You know what I mean? So that is essentially the idea here, is that this thing is, I feel I'm rambling a bit, I know, but this worth here is the growth that was experienced by the company that was once trading with 10 shares at, maybe $10 per share. It wasn't worth much. I mean, I don't think that was ever an accurate reading of the cost of it, but that is what that is. That is what the cost of it is. Now, what does that mean to us? What does that matter? Well, what matters is, there was a statement made by Warren Buffett once at one point in time where he said, or he didn't just say, but he put his money on it, where he said that you cannot outperform the market. You cannot. It's not possible. And he bet, I want to say it was like $8 million, or maybe just $1 million, that no fund could outrun the market, essentially. So there was no. So for example, here's the basic concept there. So for example, if hedge fund A and hedge fund B are both running on this competition, and we'll just say the S&P 500 / the Dow Jones Industrial were there as well, because they're obviously this is the market. This is the conceptualization of the market. These are the two that are fighting in the market, trying to outperform it. Now, the idea that Warren Buffett had was to say that, for example, if annualized, the SPY and Dow Jones Industrial, the market in general, had returned 7% on that year. I think it's a little bit more than that. It's like 11% per year. Had returned, for example, 7% that year. Under that case, it is increasingly unlikely, especially with that rate as well. Just simply like FISROX, which is a Fidelity, if you care about it, it's a Fidelity ETF fund. So it's an exchange traded fund, and it increases as the economy increases. They're conceptualized, they are marketed and modeled after the actual industrial and the SPY, the S&P 500. So that is the idea. And what they found, or what he found, was that no one was able to outperform. And why is that? Well, part of the reason is because they're so big, right? When you're so big, how do you move in and out so much so that you can really, what's the word? How do you actually? Yeah. Okay. So how do you move so much so that it allows you to move something that's bigger than you? So if you consider it this way, so you have to consider a stock or a ship or whatever as a boat, basically. Boats are very slow and they're very big. So if there's something in its way, it's gonna take a while for it to turn out of the direction out of that direction. Well, the similar thing applies here. If you have a boat, yeah, despite the fact that it's smaller, it will still have a similar amount of trouble trying to get out of the way because it's too big. That's why you can see these little day traders that have these really tiny speedboats be able to dodge these things very easily. But when you're on top of a giant ship and that thing is approaching something so large, it is very unlikely that they will be able to outperform it or avoid it. And that's the idea. And it's very slow. I mean, they're very big and they're very slow, and that's the idea here. Now, you can't, and so on a huge scale, whether or not you, and it doesn't matter to you. If you're watching this video at all, that means you're not on a huge scale, so you don't care. Will you ever be on a huge scale? That's not for me to say. I think that it's important to note, though, that you can outperform the market, but for how long, right? So if your account looks like this or whatever, and you hit this spike, odds are that spike's not staying, and it might even go further below. And the reason this happens is because you get lucky, and then the reason this happens is because you go looking for luck. So then you end up basically drawing back to this point right here, and you end up killing it here, and basically you lose most of your money here. And then you get addicted and you keep going forever. But that's a different. That's basically the story of gambling, and that's not what I'm here to talk about at all. Either way, so what I'm here to talk about is how maybe the math might work out in your favor. So here's a conceptualization that I think is pretty important. If you own $100 worth of something, and that thing drops to $90 per share, okay, you've lost obviously 10%. Okay, now what is actually required of you to get back to $100? It's not 10%. Why is it not 10%? Anyone? The reason it's not 10% is because 10% is what was the original capital that was taken away from. Now, when you're trying to add 10, you know what? We'll do the fucking math, honestly. What is 90 times 1.1? Because that's what adding 10% is like. Yeah, it's 99. That's not $100. And yeah, it's close, fine. You that's not the point that I'm trying to make. The point I'm trying to make is you cannot get back to the original number with the new number that you're beginning with. And so this is actually bad and good at the same time. Because when you have the thing you have to understand about the market is when you make money, it usually means someone else. That is the concept here. So for example, oh yeah, by the way, if you want to go from 90 to 100 again, you have to do 11%. Okay? And that will get you back to 100. And that's all well and good, but why? Like, why is it this way? Well, this is just how math works. As far as anything is concerned, we're dealing with always, and this is important because I constantly am working with options and things like that. So we have a normal bell curve, right? This is that was really, really off center. This is the 50% mark of anything that is in there. So for example, these are the things that are not in the money, and these are the things that are in the money. These are the probability, and then once you start breaking out of the money, you'll start seeing that you're not. This is where all the things expire worthless. This is where things attain value and sometimes get assigned. The idea is that when you're purchasing this, the people are paying a specific price that falls into the level of the bell curve. Okay? Now, one other thing before I actually get into the real, it's not going to be tough math, but I think I would like to start getting into the actual statistics of math. So I'll probably start doing a video on that as well. This looks terrible as hell. Before you think about it, what are options used to do? Options are used to hedge, right? So, firstly, what do you hedge? You don't typically hedge losing or winning positions, right? I'm not going to buy a put on something that I'm shorting. That's stupid. Purely because of the fact that even if I'm not dead wrong, I'll probably get pulled out of that position anyway. You don't hedge those. You do hedge, and that's what puts are for. Puts exist for this exact reason. Puts exist to hedge, which means they're going to be all right skewed. I think I did that the wrong way. They're going to be right. They're going to be right skewed. Why are they right skewed? Well, because people in general own more of them. People in general own more of these specifically for the purpose of hedging their stock. So if someone owns 1,000 shares of Fitbit or whatever, because they recently got bought up by Google, if they own 1,000 shares of this and they think that it might go down, they'll buy puts. All right, and they'll buy in the money puts, something that protects them, something where if it ends up badly, they're protected on their position. They'll only have to pay whatever, and if they're wrong, then fine, they pay the premium, but that's it. And it's usually a win-win for the hedgers. I think if you've ever seen a video with Mark Cuban, actually kind of recently, he was talking about how He's talking about how trying to remember. God damn it. Yeah. He had like $1 billion something in puts or in stock of Broadcom, broad something. So if someone's here, say it, please, for the love of God. Broadstream. All right, I'm being an idiot. Let me look it up. Is it Broadcom? Could be Broadcom. I think I was right. Yeah, okay, it's Broadcom. So anyway, shit. All right. So he was talking about how he bought puts against Broadcom. This was in a Vanity Fair video, I think. Either way, this is what you're dealing with. You're dealing with the statistical ability for your position to be right. So if you're here, so at any given point, the strike is here. This is how the puts and options are distributed amongst this spread. So there is an equal percent chance of it going here as it is going here, and this is called a standard deviation. This is defined by the average. So to figure out a standard deviation, these are defined by the distribution that is already there. So everything that is owned can help you determine what the standard deviation is. The standard deviation is also divided by, for example, in stock, you can figure it out based on the average move of a stock. That'll give you a standard deviation. The reason they're typically a little bit different in distributions is because distributions aren't necessarily changing subjects, but the stock market is, the price of a strike definitely is. So those are things that would not be the same over a long period of time. So yes, this would change. So where's my mouse? Okay, so if this is $100 and this is 105, that means the standard deviation of this stock is $5, which means this point right here, which has an equally similar probability, would be $95, right? Makes sense? Cool. That's just stock in general. Now, today, for example, I'll talk about a play that I took. So Disney had their earnings yesterday after the market closed. They had their earnings. They hit 142. They came down to 138. Yeah, 138. They were showing some weakness on their trend and stuff like that. So I ended up shorting it, but I didn't short it. I don't outright short anything anymore. I just buy puts. So for example, I bought just really easily just to test it out. I saw the puts, so I was looking at the 137 strike price puts. Now, these gain value if they hit. So if they hit, then I make money. If they don't hit, then I lose money. However, if I sell them early, then I get to keep the money. That's options 101. So if you're trying to make money on something like that, then that's what you do. You wait for it to start kind of getting weaker, and as it gets weaker, you can say, hey, I think this is going to have a big down drop, or even any more power in the downward direction will provide you more evidence that you are part of a winning trade. And so because of that, you can actually make some money on it. So let's say right here, so I'll kind of draw out how that went. So actually, you know what? Let me actually have the actual stock up, because that will make this a lot more fun. Let me think. So I'll just minimize this. All right, cool. So Disney. I'm just maximizing the All right, here we go. So I traded Disney today around, I think, 11 o'clock. Now, it was continuously, actually, no, I was actually in it for here, I believe. So it was continuously showing weakness and then pulling back and then showing weakness again. So I liked the stock. I liked kind of where it was headed, and I was like, all right, let me see what's up. And so what I ended up doing is I ended up buying share. I bought one put for, I just bought one. I only bought, so one, where the hell are you? So 137 put for $31. Now, this is my 100%. This is 100% of my investment for that stock, or of that option. Now, I had to endure a bit of damage at one point. So after, for example, when it came down, I made a little bit of money. This is back before it actually really started tanking down. So I started pulling in. This is the 1 minute, right? Okay, so it started pulling back on for me, and I started making a little bit as it got lower into 137.42, stuff like that. Around this area for sure is where I really felt a little bit of gains. There was at my highest I was up maybe what is it? Where the hell are you? I was up maybe like $6 on this. So that's not great. I mean, it's not even good. It's, if I'm up $6, I'm up 1/5 of it. So that was my percentage win on that position at that point, which is decent. I mean, it's more than most people get out of stock. So options are great for that reason, unless you want to get like absolutely fucked. So that's something to keep in mind when you're looking at this stuff. But so I got it. So that was my win at that time. However, as it got crushed up to here, I'm on the wrong one. As it got crushed up in this direction, my thing actually ended up losing a lot. It lost more than a lot. It lost about 50% of its original value. So it hit, I want to say 20, it hit 50% at one point. It was at 22, which is where it was a stagnant level. I kept seeing it hit, and I was like, all right, this is around the time where I'd want to repurchase more. And this is the logic of buying more, is that when you lose a certain percentage and then you come down and then you buy another one, you're going to recoup the entirety of that drop, assuming you're right. You're going to recoup the entirety of that drop while also gaining. So it's going to be, you're going to make that drop back. So that extra $6 or that extra $10 that I lost from here will come back, and then I will also be getting more, assuming it keeps going higher. That's the logic of it, at least. And that's kind of how you can play this statistically. I just realized I wasn't showing the screen. So yeah, that is how that kind of was going. Now there was another point where it just kept going higher. So if I show you again, so this strikeout was where I was down 22, and then it came back down a little bit, came back down. It was, when was this? Yeah, it came back down again, and I was up a little bit. It hit 137, and it bounced from there. And then that bounce cost me all the way. So at that point, my option was worth about, right, let's get my pen back. My option was worth about 0.16, and so I had lost at that point about 50% of my original investment. Okay? However, if this fucker makes it back, how much do I make? On this investment, I make back 100%. On my original investment, if I hadn't changed anything, I would have made back 0%. That logic is really important here. If you can follow that, and I just realized I'm not showing it again, that logic is very important. And if you can follow it, then it gives you the ability to earn actual money. This should be seen, always should be seen, if you're right about something, and you have to really know it, this should be seen as the buying strike price for you. Because at that point, I was just testing it. But had I bought it, and by the way, at the end of it, I didn't end up purchasing another one because I was just watching for the price action. The position had gone from 0.16 all the way to 0.42. Actually, I think I sold it a little bit higher. So I bought it for 31. I sold it for 0.43. So I had, let me write that a little bit better. 0.16 goes to 0.43. I had made, on this total trade, without having purchased more, I made, what is it called? I made $12. Okay? Now, $12 of $31 is not a huge, amount, obviously. It's, I can do the math real quick. 12, 31, 38%, roughly. 40, 30, 30, 38%, 35%, Jesus Christ, about 38%. Now that's a great little return on a intraday prog. 38%. Had I put in $1,000, I would have made $380, which is great if you're trying to make quick money like that. However, there's a much smarter way to have gone about this. Instead of getting my extra $12 at the very end of that lifespan, why not instead like quadruple or sextuple down at 16? So for example, I lost 50% on the original downtrend, but now I have a golden opportunity to make quite a bit more. Now, if you do that, if you can conceptualize these, then you start taking, all right, let's start our new cost basis and make it 16. All right, our new cost basis per option contract is $16. And then if it goes to 0.42, but like I said, hindsight's 2020. That's why no one invests like this. 0.42. If it goes up to 0.42, what do you stand to make? What is that change? And the change is 2.6. So about 2.6. 2.5, 2.6. So it's 2.6. Jeez, I need my calculator. 2.62. 42. 43. Divided by 16. Lord have. 43 divided by 16. I can do basic math. Yeah, okay. This is not, I did this wrong. 42. There she is. Okay, so 2.62, so 262%. That's roughly what you're going to get back. Now, if you can time that properly and you put in, let's say, $10, and you're getting 262 out of that one, that is going to turn into about $26. Did I do that right? Yes, I did. Finally. Okay, so $26. That's $26 of profit. That's the change. So the whole position will be worth about $36. Now, the reason that's really fucking amazing is because you don't need those drastic changes where the stock goes up 6,000% and then you take 4 seconds out of an option just to make money on it. You can time these and you can learn to make profit off that. For example, you put in a little test dummy. You're willing to lose $30, then the $30 is gone. That's what I was willing to do. I put in the $30. I lost it. I lost 50% on it to get that price at 16. Now I know the price. Now, if here, and say I had $1,000, if I had $1,000 and I rode this wave all the way to $42 or $0.42, which is 2.625 more, the value of my entire position gets multiplied by 2.625. So, and that also math is, I do not believe, correct. It's 1,000 times. Yeah, no, that's right. Okay, so 2.625. And then you've made, that's your profit right there. This is not something you will get all the time. If you for an upfront investment of 1,000, then you get out, 1,600 from it. That's a great bet to make if you can time those. This is all math. You don't have to go for those crazy moves. I talked about this in the Amazon play where my spread was 2 cents per each contract, and then it hit 42. Yeah, okay, fine, fuck it. I lost on this play. I bought it for $99 so it was 0.99, right? Or like 1.09. No, this isn't even right. 1.09. So I lost $107 going into this. But now, once it hit its level, and then Amazon decided to shoot the fuck up, what should I have done? I should have tripled, quadrupled down in this position like nobody's business. Why? Because if I put in $100, just $100 in this position at 2 cents, would have given me 50 contracts. Okay, or it would actually given me 50 times 100, so 5,000 contracts. But it would have given me 50 of those contract deals, and then it would have given me 50. I'm dumbass. 5,000 shares, 50 contracts, at $42 per contract. Right at the peak. Actually, it hit more than 42. That's not true. It hit 50. So it hit $50, $52, $56. But I'm gonna say, for the sake of this argument, I'm just gonna say it's 50. So 50 times 50 gets you what? $2,500. How much was the original investment? $100. What did I do? I multiplied it by 25. That's the math. You can do this over the long term. If you can figure out the standard deviations, if you can figure out what the profitability of something is, what the percentage of return is, then you've got yourself a winning strategy. But if you lose fucking... All right, let's do a little bit more math, and then I'll cut this video off because it's 40 minutes already. Okay. Let's say you start with 100%, and say you lose 20% within the first week. Okay, now to make this back, you need to make, I think, 24% in order to recoup whatever to get back to 100%. That sucks, obviously. You need to make more. But additionally, it's those people who lose, 1%, 2%, 3%, 4% every day and then make a 10% gain in one day. They're not recovering, but they're blown away by this trade right here. Then they just continue to drop it. And that's what everyone's account looks like. So if your account looks like this and then looks like that, and then this is called a dead cat bounce. So this isn't what you want out of your trading. You want longevity. So you want to make 5% one day, 5% the next day, and then 5% the next day. Because 5% of 100 is just 5. Okay? So you're left with 105. Let me clear this again. I need a different... Paint is so old school. That's why Microsoft is a trillion-dollar company. So you start with $100, and you make $5. Who gives a shit? It's $5. $105. All right, cool. Let's make another 5%. You know what compound interest is? So what's 5% of 105? Anyone? I'm actually just doing the math off the side. It's it's what is it? 105 times 1.05 should get you 110.25. So 110.25. All right, cool. So what's the change? We got $5 extra plus 25 cents. But now you have a higher, now 5% of this is even more. It's 0.2. So you keep growing that investment. Eventually, if you hit $200, if over the course of 3 weeks you do this and you hit $200, that doesn't look like a $200 at all. If you hit $200, what's 5% of this? It's $10. All right, next day you're at 210. All right, you make 5% of that. You get the idea? You grow slowly, and these high returns are going to kill you if you don't learn to manage yourself on those. So yeah, that is something I think trying to talk about something else, but I also forgot what that was. But this was fun. This was the concept of math in the stock market. So I think keep stocks close to home when it comes to mathematics. It is very important, in my opinion, to be very smart about this. When you trade, it is really important to understand what you're getting yourself into. What the probability of something is. Like the probability of this could go either way, but do you have something that could hit? Do you have something that will result if you put in $50 on this side and $50 on the other side? What is the probability that you will make at least, and this is at least 100% in order to recoup the previous investment that's about to lose zero on the next day? That's how you play earnings. So this is all a statistical game, and I'll get into that, I think, in my next video. But, thanks for watching. I'll see you guys next time.